Hi, everyone. Welcome to our rental income property 101. If you're thinking about taking advantage of the market, looking to purchase, buy a rental property, you came to the right place. We usually do this on the weekend. Yet we thought we would mix it up a little bit and do it now.
This is a happy hour type event. So for those of you out there who are getting off work, you need to unwind, you've been working from home all day long because of COVID, you can have a cocktail while this is going on, and you may like it even better.
Well, why don't you take the reins and kind of start us off?
I'm going to start this off. So if you haven't attended one of our world famous seminars, I know me and Vinnie, we're probably near 1 million followers, probably average on these type of events that we put on. We're going to go over this again. So you already own a home. You knew what it took to get the home. You knew what it entails. You understand the process. You know it takes time and money, but you look at it now with the only thing that's constant is change, and you go, how can I make more money and not work forever at my job? So you have a job, your income's steady. You have a retirement plan, you have savings. You already own your house, it's appreciating value, but will that go up forever, Vinnie?
Nope.
It
goes up, it goes down, it goes up.
That's right. So that's why diversification is so important. But having your house, having a retirement plan, having a job is not going to create lasting wealth. You need to diversify, and that's where real estate comes into play, because investment properties build wealth because they make you money while you sleep, which I love that idea.
It's a great avenue to have. All right. So how do investment properties build wealth? Monthly cash flow. Rental properties can create cash flow. Rental properties have the ability to increase cash flow by rent increases. Average San Diego rent, $1,800 to $2,700. Average yearly San Diego rent increases 4.1. Downtime 2.7 in bad times. Future appreciation, San Diego average appreciation about 5% yearly. Now be aware, the market goes up, it goes down. Be aware of that. It doesn't seem we do have a massive shortage in San Diego. So the market's not going to totally drop. I mean, I wouldn't think so yet. I mean, the higher we go up, usually, if history is a good indicator, the farther it goes down. So we'll see what happens over the next couple months, year. As renters pay your mortgage, your appreciation goes up, and then tax write-offs. We're not CPAs.
We are not CPAs. This is correct.
But having a rental property can be a great tax write-off. You can depreciate the property for more write-offs, tax insurance, mortgage interest, all written off. Maintenance, write-off, 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 write-off.
So how do you get started?
There you go.
How do you get started? Well, unfortunately, people, you need money. Just like anything in life, if you want to get and build something, you usually need some sort of startup capital. So can you get started in buying investment properties with no money? Maybe if you can pull a bunch of investors together and, somehow work your way into an equity situation, which some of you may be able to do. That's an interesting proposition. I seem to be getting those phone calls a lot lately. Vinnie, people calling me with equity positions, which is interesting. But besides that, how do you get started? You can pull money out of your current home. How do you do that? Cash out refinance. For those of you who live under a rock or haven't noticed current economic times, interest rates are at all-time lows. If you haven't refinanced already, talk to me, talk to your preferred lender, talk to somebody about saving yourself some money. Otherwise, you can pull from your investment accounts or bank savings. Investment accounts like 401ks, you can take up to $50K out of your 401k, use it for a first-time investment purchase, or you can do a hardship withdrawal. Very interesting, very unique ways, but it is a way to get access to a capital if all your income or all your savings is tied up in your 401k. The other thing that's for more savvy people is an IRA investment real estate account. That's for people who have IRAs, and then they want to actually make it into a real estate investment account. Or fourth, pool your money with other investors for leverage. Fifth, HELOC. If you already refinanced your property and you have an amazing deal and you're like, oh my gosh, I already, did everything. Why do I want to do that? Because cash out refinance is more expensive than a rate and term refinance. Not to get into industry jargon, but the rules changed on cash out refinances in November. They're now more expensive than they have been in the past, and they are more expensive than purchase loans. So you may want a HELOC. That's a second mortgage. And then right here, cash is king. But on this show, we're not people that are,
Or opportunists.
Cash can also be queen too. Let's be fair here, Vinnie.
Now going over what David's kind of already talked about, how to get started. The cash out refi, right? If you bought this property a couple years back, you probably have equity in your property, and your rate is probably a little bit higher if you haven't refinanced over the last couple of years. So by cashing out, taking money out of your property, your payments might not be as high as you think they are, or they will be. So something to think about. Talk to your lender, talk to your realtor, and see what's possible before you make your decision.
You missed one of my favorite slides. So
yeah.
I actually love this slide because a lot of people ask Vinnie, they ask me, they're like, why do you guys like San Diego so much? Why do you look at it as a good investment source? We put this slide in here just to kind of show you. So it's unique, San Diego's location. And real estate is location, location, location. So the unique thing about here, we have the ocean on one side, we have the mountains and the desert on the other, and you have a limited amount of space. When you have a limited amount of space, that means you only have a limited amount of homes, which means that demand, in theory, if history is going to, repeat itself, the demand will keep going and the prices will keep rising, even though we will have dips. But if you look at historically San Diego, our prices continue to climb up. Talk to your friend that bought 5 years ago. He'll tell you he wouldn't buy the same house at today's prices. So it's a geographic location that helps you out with San Diego.
So what's most important to build an investment property? Is it the monthly cash flow? Do you want the highest monthly flow? Do you want the ability to be able to increase your rent yearly? Or are you just getting with the first property and then later planning on cash flowing because of the rent increases? Okay, is it a yearly appreciation? Do you want to buy an area that has greater yearly appreciation for possible 3-year sales to leverage? This one kind of hesitant in this current climate yet. You could look at areas that are being gentrified.
Oh, man, I saw that coming a mile away.
Or are you buying an area with a lower appreciation because of pricing? Or buy because of appreciation down the road for financing improvements? Is the safety of the investment? Is the location of the property? Stability of the rents monthly? Long-term tenants versus short-term tenants? The need and maintenance of the property? Type of tenants? College, business people, families? Based off the area you're buying in, you're probably going to have a different level of renters in your property, right? Also factor in single family, duplexes, triplexes, and fourplexes.
Wow, you're on fire. Look at you, you're just blowing through everything.
So why don't you take the differences? There you go.
So let's take a look at some of the differences. And we did blow through some of the slides about your renters. Let's kind of pause and look at that really quick. The renters you have each can give you a different amount of money. You're going to have a family, let's say, that's more stable, probably not going to pay as much money as someone that's paying month to month, is also different. And then also it's going to depend on your type of renters, the property that you buy. That's something that's super important. You got to remember, when you didn't own a home and you were a renter, how did you treat the property? Because that's super important to avoid other mistakes. With that being said, upside, downside on rental properties. Single houses, well, they're easier to maintain, but it's one house, one cash flow. Duplexes, more expensive, harder entry point to get into, but now you have two renters, two sources of cash flow. And then we go into probably my most favorite 3 to 4 unit properties. Entry point much higher in San Diego, down payment much higher in San Diego, but you have 3 to 4 sources of cash flow, and you have the ability to do more things to the property. There it is, boom. You have more ability to do things to the property, increase rents, longer term, and increase cash flow. And that's why we're all here, because I don't know about you, Vinnie, but I don't want to work forever at at this job with my tyrant boss. It's terrible.
Yeah, I heard he's a jerk.
Yeah.
But going in and dissecting the different properties, right? There's a baseline of what people will pay for rent, right? So the higher you go up in rents, right, the less people that can afford it, right? So when you look at single-family homes, duplexes, triplexes, fourplexes, things like that, the more units you have, generically, the better the margins you're going to have, usually, right? Because for a single-family home, you're going to buy people that don't want to be, landlords. You're going to have people that are buying for primary residence. Duplexes, you're going to have less people, right, purchasing those properties. Same thing with threeplex and fourplexes. So talking to your realtor, figuring out what's possible, and then going from there. And this could be a great avenue too, duplexes. We didn't really talk about it. But let's say you have your VA eligibility. Maybe you buy one unit and rent the other one out, and now you're basically getting some money to offset your payment.
Oh, is there a wrong property to start with? Of course there is. Let's look at dating. Is there a wrong person to date? Of course there is. So there's also a wrong property to buy as your first property. So you got to remember your goals here. Think about it. Was it the cash flow? Is it the appreciation? Is it the leverage up? Is it the safety of your investment? You need to know your goals. Can you afford to lose a renter? If you buy a single family residence and you look at the new COVID laws are going to say you can basically live in that place until September without paying rent if you're affected by COVID. If you buy a rental property, single family, and your renter can't pay, can you afford to pay the mortgage? Because that's something that's super important. You got to be able to afford to pay this mortgage. So be prepared to lose a renter because you probably will. Do you have reserves for things when they go wrong? Because guess what? Things will go wrong. And here's my favorite. Can you bootstrap to get the work done?
What's bootstrapping?
I'm glad you asked, Vinnie. I'm glad you asked. Bootstrapping is not putting straps on your boots. Bootstrapping is not the way you put on your shoes. Bootstrapping is being able to do your work yourself. And I'm glad that you mentioned that because we just lucked out today. I'm just going to show you something really quick. From doing bootstrapping myself, that's why I have Makita drills and levels, because I like to stay on the level and I like to bootstrap and do my own work on my properties. Didn't really plan on that, but I was doing some work in my office today. So we have the Makita tools. So if you're going to bootstrap, you got to have tools. Tools cost money. Don't buy cheap ass tools. Buy expensive, good ones. They last. And finally, patience. Do you have patience to work with people? If you do not, dealing with renters will be very hard. So take that in mind. You got to have patience for people.
Let's look at some ways to prevent you from choosing the wrong property. Know your neighborhoods. Okay. Know the area you're buying in. What's the average income? What's the average rent paid? Rentometer, great platform to look at. What is the crime rate? Crimespot.org. What's the rate of appreciation? Talk to your realtor. If you don't have one, we can kind of walk you through it and show you what the values are, or what the future value, what the past values have been. You kind of use those. Average rent turnover. Know the property. What's the age of it? Deferred maintenance of the property. Piping, electrical, roofing, right? Older properties might have the cast iron piping in it. The newer ones might have PVC in it. Know the difference, okay? Electrical, roof, permitted, non-permitted. Yes, properties can sell with unpermitted areas of it. Yet there can be issues later on with that. You usually get a property a little bit cheaper or something that's unpermitted. Yet there is going to be value attached to it. So be aware of that. Accessibility to parking, zoning, legal upside units, average cost per square foot. What improvements can you do to bring more and more rent? And then why?
Oh, look at that. That is the balance of power. You want to balance this out. This is about you being able to make the right investment and still sleep at night, balance your workload, balance your life so you still can able to enjoy the finer things in life because life moves fast. Oh, wait a minute, Vinny. With that last slide, I forgot to mention, if you're working with a realtor that's in the top 20%, they may miss some of those items.
All right. Learn about mortgages and great, and that's a running joke about
Top 20.
the top 20%. If you sold one property in the last 12 months, you're in the top 20% of all realtors in San Diego County. So, okay. Learn about mortgages and great CPAs can help you with tax benefits. Non-owner properties and mortgages. Duplex will have higher rates for loans. When you buy an investor, down payment is usually 25%. If, let's say, you buy a duplex, triplex, fourplex, you live in one unit, rent the other ones out, you could use it as a primary residence, so you don't have to pay those high that percentage of down. You can do a VA with no money down. So be aware of that.
And you could do FHA, buy 3 to 4 units with 3.5% down. I know we talked about this. I had a VA buyer buy a 4-unit place in Bankers Hill with no money down. So you have to kind of think and be more creative. You can also buy duplexes with 15% down, not 25. The standard usually for your best deals are 25% down payment. But if you're getting just into the game, feel free to call me or Vinnie, and we'll help you with some strategies to try and get you in there so that you don't have to work forever working for the man. Yeah, more equity in your property means lower rates. So think about that. If you have better equity in your property, you'll get a better deal. And then your CPA. For those of you out there who like to do your own taxes and you're do-it-yourselfers, there's a couple of things you shouldn't do yourself. Plumbing is probably one of them. Being a CPA is another. Don't be your own CPA. You're not up to date on tax codes. Pay somebody to do it correctly. A good CPA will save you thousands of dollars. And remember, you get what you pay for. If your CPA is Walmart priced, he or she probably has Walmart knowledge. So be careful. I just made that up on the fly in case you're wondering. Truth be told, I love Walmart and I own the stock, full disclosure, but I don't have a Walmart CPA.
Make friends with honest contractor. Doesn't matter if it's Walmart, Target, any of those platforms. All right. Now this, I think, some formulas to help you with your return on investment. David loves these ones.
Okay, so these I actually really like these. So, these are just simple formulas to help you out. You also should learn about the cap rate. We didn't put that on here, but once you use these formulas, if you want to contact Vinnie or myself, we'll get you how to do cap rate. Cap rate's super important too. So cash on cash returns. You want to look at this. This is your annual cash flow divided by your initial cash investment. So if you look at this, you bought a rental at $700,000, down payment, 25%, $175K. Annual cash flow from rents is $42,000. Figure $3,500 a month. That's actually pretty low in San Diego. If you figure each side, what it would rent for, it's pretty cheap. Divided by your down payment, that's a 24% rate of return. Boom, amazing. Vinnie loves that one. If someone can find me that deal, I'm all in.
Yeah, I'll take it too.
Then net operating income. This is important. Why? Because you probably heard Vinnie a couple of times tell you, can you afford the monthly payment? Can you afford the monthly payment? Make the monthly payment. This is why we did this formula. Net operating income. It's your annual income. It's your annual income less your annual expenses equals your net operating income. So, example, you made $42,000 in rents, yet it cost you $12,000 to operate that property. That means you look at it, you made $30,000 of real operating capital. Divide that by 12, that's $2,500. Is your mortgage $2,900? That means you're in the hole $400 per month, which means you better hire a damn good CPA or you better not lose your job. So that's why we like the net operating income. It's a great one. Payback period. You worked hard for your money. You saved your money. You worked long hours, double time, overtime. You want your money back. How do you look at this? Payback period. In our example, you spent $175K. Divided by the amount of money you bring in rents. It's 4.17 years in our example. That's how long it takes you back to get all of your money back. So these are your starter formulas. I would highly advise using all three of these and then actually using what's called the cap rate. which, like I said, you want to know what it is, email Vinnie, email myself. We'll help you out with that.
So what else should you do to protect yourself? Learn California renters laws, because there's a lot of protection, especially with COVID going on. There's a lot more. Only hire a qualified realtor to help you and a qualified lender. Okay. And we don't have it here, qualified, but qualified lender. All right. Property managers, do you need one? Learn the cost. They can usually vary between 6 to 8%. Plan on things going wrong, because they will go wrong.
Guaranteed.
Insurance is better than cheap insurance. You need a great insurance agent, feel free to reach out. We can set you up with one. Realize you're playing the long game to create wealth. You're prepared to take some risks. They're calculated, though. Cash is king and queen. You'll need it to operate and ensure you can sleep at night. Buy rental units, live in one for a while so you can fix it up. Always look for ways to increase the value. The equals increase rents. Always look for ways to decrease costs, because never screw over a tenant. A happy tenant is going to stay with you a long period of time, and then you won't have to worry about basically having a bad tenant in there that ruins your place up.
Yeah, you have to remember, treat people well and choose your renters wisely. A lot of people do credit checks to check on people. That's highly advisable. If you run a credit check on someone and you notice there's collection, late collection, chances are they will pay you late and screw you over. All right, so now you get the basics. What are you going to do? You got to go look at properties. Well, better not hire a realtor in the top 20%. So I'm using that, Vinnie, because I think that's a slide that should be shared. I don't think you have that available, do you?
Let's see real fast.
Back to the slides. Look at, oh, boom. Just go over this really quick, Vinnie. This is on here because it's so important that you hire the right realtor. Do not hire your friend just because they got their license yesterday. Don't hire your former cousin's uncle's roommate because they got their license. Hire a professional. Be careful.
To get in the top 3%, look at that again. To get in the top 3% is 10 plus deals in San Diego County.
Wow.
All right. Well, look at the rent, use the formulas, know your goals, and let's build that wealth.
Build those Benjamins. It's a house full of money. Wow.
We did short and quick right there.
23 minutes.
Yeah, we still allowing you the time to basically grab a cocktail, grab a drink, enjoy yourself. If you have real estate questions, reach out to myself or David. We would love to be a resource for you. Any last parting words?
You know, I would tell you the only thing that we go over a lot, Vinnie, the only thing constant is change. As you notice, me and Vinnie keep telling you the market goes up, the market goes down. It will not go up forever. Please be prepared for that. What will go up later is interest rates. They will stay low for probably at least till September this year, if not October. But at the same time, it's like you will have fluctuations. So you want to get in there, hire a pro, take your time, think. It's a marathon, not a sprint. So prepare well.
All right, guys. Well, thank you for joining us. And please subscribe, please share. Have a great weekend. We'll see you on Monday.